Hello, this is PC here from Global Alpha Search. Welcome all eToro investors. I hope you're okay today. It's the middle of July right now, and I thought it's a good time to kind of make a quick summary, mid-year summary of how the portfolio that I run on eToro looks like. We've been here since December 2020. So not a long time really, but I think we used this time very well to slowly build the portfolio properly adjusted for the economic cycle phase and prepared for what's coming ahead of us. So recovery and expansion phase. We are a long-term portfolio. I will run through the details later, but please remember that we are a long-term investing portfolio here. No short-term speculation, no trading around. I invite you to invest for the long term, as this kind of investing has a lot of pros, and first of all, it vastly increases your long-term returns. As one of the famous investors once said, the money goes from the ones who trade to the ones that hold positions. And I think this saying is very close to our philosophy here. Yeah, let's get to the point. Today, I wanted to run you through the portfolio characteristics. The tool I use to do that mostly is Morningstar. I like that a lot. This site really gives a lot of quality and a lot of value if you want to run your portfolio there. A lot of sectoral analysis you can do and other very important tools and statistics that Morningstar usually draws out of your portfolio. So let's get down to the point. Let me just share my screen with you right now very quickly. Yeah. So let's start with that, with this section here, asset allocation. As you see here at this point of time, we have 55% of our portfolio invested in US stocks. We have almost 20% invested in international stocks. These are stocks mainly from developed Europe, and we've got a little bit of Asia in the portfolio as well. Going forward, I will plan to keep diversifying geographically, especially towards Asia. Bonds, 14%. That's in line with our investment philosophy for the economic cycle phase that we're in right now, which is recovery. We're planning to have long-term treasury bond ETFs in our portfolio, a little bit balanced by shorter-term bonds ETFs like SHY, for the fact that we want to have a little bit of a shorter duration of our bond holdings. But we basically plan to keep between 13 to 17% of our portfolio for this economic cycle phase for the moment. The other part of the portfolio is obviously gold. We have 12% of our portfolio in gold right now. From the stock style diversification perspective, as you can see here, our portfolio, our equity portfolio is mostly concentrated around growth stocks, large growth stocks, and that's in line with our investment philosophy. We're looking for big companies that are usually leaders in their sectors, global leaders. And most of the time, once a stock passes SIA scoring, it's most often a growth stock. So that's in line with our investment philosophy. As you see here on the right side of this section, our interest rate sensitivity is high, and our credit quality is also high. So I'm very happy with the credit quality, of course, because our stocks are supposed and meant to be very safe, not indebted. As you know, one of the points in SIA score puts a lot of emphasis on the net debt to EBITDA ratio. We're usually not picking stocks that have above 1.5 times net debt to EBITDA. So high credit quality is very, very important for us. Obviously, because of the growth specifics of our portfolio, it's a little bit sensitive to the interest rates. So in times like February and January, February this year, for instance, when we had all of the talking about the suddenly rising yields, our portfolio struggled a little bit, but I will move on to that when we go exactly through the details of how the portfolio performed this year later on. Let's take a look here. Stock sector split and its comparable situation to the S&P. As you see, and this is natural, we are quite exposed to the sensitive sectors, which is communication services, but first of all, technology. If you take a look at the equities that we hold right now, these are mostly technology stocks, and that's obviously also in line with the SIA scoring, which assumes that we're investing in stocks that are in sectors that have quite a bit of growth ahead of them, because we want to basically be exposed to the stocks that present the biggest potential value growth for the investors. Cyclicals are there in our portfolio as well. We have less of cyclicals than the S&P 500 index, obviously, but you know, this is also pretty okay with me for now, given the fact that going forward we will most possibly swing a little bit into the financial services sectors. I'm planning to be adding holdings here, so I think this digit will most possibly grow. Defensive, consumer defensive, healthcare, and utilities. Not the kind of space for us. It's mostly, you know, for times when things go bad. So I think into the boom and ahead of the cycle peak in a couple of years, we will maybe get a little bit more exposure here. Stock type section, as you see, cyclicals concentrated in the portfolio, a little bit more than what the S&P has as far as the weighing for cyclicals is concerned. Aggressive growth stocks in line with the S&P, slow growth pretty much double or close to triple of what the S&P has, but we're okay with that. Most of our stocks are very large, stable technology stocks, so they kind of fall pretty nicely into the slow growth category. So we will most possibly keep overweight here. Also, please remember that those comparisons to the S&P are obviously purely theoretical. S&P is by no means our benchmark. We are a cycle adjusted fund here, so our allocation in the equities basically swings along the economic cycle. So in the times like right now in the recovery and expansion, we will be mostly an equity fund with up to 75% allocation. But in times of boom and recession, we will have much less exposure to equities. So our final and ultimate benchmark is basically, as I have already mentioned in my other materials and videos, stable, long-term, positive nominal returns with minimal drawdowns and constrained volatility. So the back testing is showing around 9% long-term CAGR for our portfolio with no stock picking. With the stock picking that we're using, I'm expecting those yearly returns in the long run to be between 10 to 13-14%, and if compared to the risk that we're having in our portfolio, I think it's a great mix of getting the appropriate long-term returns compared to very, very strictly constrained risk rules that we have in the portfolio right now. Not only right now, but in general, obviously. Stock stats very quickly, 22% forward PE in our portfolio for the equities that we hold, and that's in line with the S&P. Price to book is a bit higher than the average for the S&P, but that's also okay because most of our stocks are growth stocks, so their pricing is usually higher. That's why compared to the book value, this ratio is a bit higher than the S&P, and I'm okay with that. Return on assets, almost 30% higher than the average for S&P, and I'm happy with that. And the return on equity for our equity holdings is kind of in line-ish with the S&Ps. Projected EPS growth for the next 5 years for our equities is almost 20%, and it's almost 50% higher than for the whole S&P 500 index. So this is very crucial to keep in mind here, because that's why we invest in the growth stocks that are leaders, global leaders in the sectors. That's exactly because they have above average projected EPS growth, and by that they will also be able, assumingly, to produce above average free cash flow for us as their investors. And obviously free cash flow is the ultimate value producer for growth stocks, right? Yield also better than the S&P, and I'm happy with that, because most of the growth stocks don't pay dividends really, but we're still making it in our portfolio to have a better yield than the average for the S&P right now, which is exactly 68 basis points. We have 85 basis points here. Let's just move on to the details of the portfolio. Yeah, so here is basically just a general overview. I think we won't spend time on that. Let's just move on. Stock style interpretation. As you see, mostly large stocks, mostly concentrated in large growth space, but we also have almost 40%, over 40% in large core and value stocks. So I'm constantly working on, adding more stocks that are kind of doing the growth kind of side of our CS scoring system, but on the other hand, they also have quite a bit of value characteristics, and I'm very happy with that. One of the stocks to be mentioned here, large value, as you see, is stocks like Biogen, one of our major holdings. Cisco Systems also added recently, and I plan to be adding here as well. Intel Corporation, everybody knows that one. Micron and Royal Dutch Shell, also our recent buy, that basically adds value, adds diversification, and adds a little bit of exposure to some old economy sectors. I'm talking about Royal Dutch, obviously. Mid caps altogether present slightly over 11% of our portfolio. I plan to be adding exposure here to further diversify the portfolio going forward. I'm right now in the process of analyzing 3 to 5 potential new holdings that might come to the portfolio in the next weeks and months. Let's move on very quickly. Here is also a short summary of our exposure on a comparative basis to the S&P, right? So you see here, as already said, we're a bit more sensitive than the average index, right? Equity index. We have We have less defensive stocks, and we have consumer cyclicals, and the portfolio is a bit exposed to that. But all in all, from the stock sector perspective, we have less cyclicals than the S&P. We're planning to be especially adding holdings in the financial services space to kind of grow this digit a little bit going forward. Stock type analysis, pretty much again, similar conclusions. From the stock type perspective, we're kind of overweight versus the S&P into the cyclicals, and slow growth is basically where we stand out, right? Aggressive growth, we're in line with the index, but slow growth is in line. And as I already said, this is the sector where we want to be, because it's mostly good quality stocks with a lot of cash reserves, with a lot of financial stability, with good credit ratings, and so on and so on. Moving forward, we've been through that already, so I will leave that out. One other thing I wanted you to pay attention to is the bond style. Our current bond holdings is the TILT, so TLT, which is a long-term US Treasury bonds ETF, and it constitutes 88% of our bond holdings. And we also have 12% right now in the SHI, so shorter-term US Treasuries are there in our portfolio as well. This is mainly to basically shorten the duration of our bond portfolio a little bit, and going forward, dependent on how all this inflation situation right now is going to look, I might be adding a little bit of SHI and maybe decreasing a little bit of my TILT exposure to just further lower the duration of the portfolio. Now let's move on quickly to the interpreter of our portfolio, and here are some very interesting conclusions that we can make. I would like to start with this one: stock style diversification. And Morningstar says here, compared with the broader market, your portfolio stock exposure is biased toward large cap companies, and that's what we want to be, where we want to be, basically large cap companies. Among these issues, it is worth noting that you have a good mix of conservatively priced value stocks and aggressively priced growth stocks. I already talked about this, and this is exactly what we want to have. We want to have growth stocks, but on the other hand, we want to have stocks as well that have characteristics of both growth stocks and are still being a good value stock, are not very highly priced. This is very important for the diversification and the risk characteristics of our portfolio being as good as they are right now. Depending on your investment goals, you may want to further diversify your portfolio by increasing your exposure to small and mid-cap companies. That's exactly what I'm gonna do going forward. As I said, I'm already analyzing some potential picks for the portfolio going forward. Now here, asset allocation. Your portfolio is aggressive with 75% equity allocation. This is quite obvious right now. Remember that our allocation in equity swings as the economic cycle phases change. So we're not going to be all the time a 75% equity allocation fund. This is going to be much less once we enter from expansion into the boom phase. The allocation is then going to fall to possibly 40-50% equity allocation, and ahead of the cycle phase peak, we're planning to have no more than 20% equities allocation and be mostly a bond and gold fund prepared for the next recession to come. Financial planners typically recommend these types of mixes for investors who have investment horizon longer than 10 years. We are a long-term fund here, and anyone who joins us is obviously not expected, but it would be great for you to become a long-term investor as well, because as I already said, long-term investing has a lot of pros and hardly any cons really. So I deeply suggest for you to be a long-term investor. Obviously 10 years is maybe a little bit of an exaggeration here. I think a time investment time period of 3 to 5 years is already a good long enough time to basically call yourself a long-term investor. Going forward, just quickly, basically, because we have already mentioned that a few times, sectors where we are not really that well exposed, it's financials, as you see here, energy, industrials. We're not planning to add much. This is because of the fact that SIA scoring basically excludes most of those kind of stocks, but we'll see what happens. We're definitely going to be adding some financial services stocks going forward to maybe try and get some positive returns in case of higher or growing interest rates once that finally happens. We're well exposed to communication services, and we don't have enough consumer defense. I already talked through this, so there's no sense spending time on that here. Average mutual fund expense ratio that we have for the ETFs that we hold, which right now is tilt shy, and the CQQQ for China is spot 28. So this is a very good expense ratio. We're not overpaying for the ETFs that we hold. Okay, guys, I think that's it from the interpretation of the portfolio's quality characteristics side. So now let's just move very quickly to the performance of the portfolio so far this year. As you see here, we had 2 down months, which was January and February. And these were the months where we had all of the surprising readings on inflation and that sudden rise in the yields on the 10-year treasury bonds in the US. Still, the portfolio behaved much better than most of the risky assets on the downside. That's exactly what we want to be achieving going forward. Since March, when the situation stabilized and in here, we managed to increase our equity allocations from roughly 40-50% to almost 70-75%. We used the dips to buy some good quality stocks. And from March on, situation calmed down. And as you see here, since then, we are experiencing very stable returns. And pretty much each month since then is either flat or positive for the global leaders portfolio. So far this year, we're up 2.5-2.6%. The volatility is constrained, and the Sharpe ratios and the Sortino ratios are on the expected levels, appropriately around 1.7 for the Sharpe ratio, which is very good, 70% higher than the minimum for a good quality portfolio. And we are right now at around 3.6 for the Sortino ratio, which is also almost double what is necessary for a portfolio to be called a good quality portfolio from a risk-reward perspective. Just a few more things to mention here. As you see, we are having almost 60% profitable weeks, and our average holding time is now 5.5 months. Well, we've been here for 8 months only, so it's still not long enough. We're a long-term fund here, and this digit will definitely keep growing, as I have already said many times. Once the stock enters our portfolio, it stays there for quite a bit of time because of the fact that we want to be growing with the company for the long term, and we have specifically selected these companies to be with us and make their returns for us in the long run. Very quickly through the portfolio right now, just to not to hold you too long. Tilt, major holding right now. These are the long-term treasuries. Gold, as I said, 11%. And now we have all the stocks, right? So the biggest 5 holdings are equity holdings on Novartis, Booking.com, Microsoft, Facebook, and Apple right now. So as you see, big companies with very good quality and very good financial liquidity. These are the smaller holdings here. So you can obviously check all the portfolio for yourselves whenever you want, just by checking up on my eToro website. So this would be it from me, guys, for today. Please don't hesitate to contact me anytime. As you see, I'm based in Warsaw. If anybody is around, I'm happy to meet you. And if not, just ping me an email or contact me on my social media or just on the feed on eToro. Thanks, guys, and have a nice day. Cheers.